the action in gold over the last couple of months is a gift. I think this is a wonderful opportunity for those investors who have been, since the late 2015, early 2016 bottom, have been kicking themselves for not owning enough gold. Now, okay, here's your chance.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Jesse Felder from the Felder Report. We're here for the SD Weekly Metals and Markets Wrap. It is Thursday, July 19th, 2018. Jesse, thank you so much for joining us today.
Hey, thanks for having me.
All right, now I'd like to turn it over to James Anderson at SD Bullion for the first question for you.
Hey, Jesse, thanks for coming on. Since we last spoke in early May of this year, we've seen a little bit of change since then. We've seen some further U.S. dollar strength versus other major currencies. Seen some downward pressure, especially recently, on precious metal spot prices, an increase in trade war rhetoric, et cetera, et cetera. Yeah, I just wanted to, I watch your Twitter feed. I definitely watch your posts and podcasts, listen to those as well. I saw recently you tweeted out something that kind of goes along with your inflationary turn-up trend that you've been talking about labor market trends, how a lot of companies are having to boost pay and benefits to attract and retain some workers, et cetera. So I just wanted to hear your thoughts on maybe what you've been seeing over the last few months in that regard, as far as labor market and even inflation.
I continue to monitor these trends, and it's been really interesting because as these things continue to become more obvious, I think the inflationary trends, and especially in terms of the labor supply demand dynamics, gold's just not paying attention. Gold's been pretty ugly over the last few weeks, but it's certainly not paying attention to inflation, and that's one of the charts that I've been watching recently and tweeted maybe a couple weeks ago, was just that divergence between tips, which have been doing really well over the last few weeks, and gold's been going the opposite direction, which is really pretty rare. Actually, I think my friend Jason Gepfert did a study about when that divergence grows that large in the past, or has grown that large in the past. It's been a good sign for gold over the next 12 months. I think he said something like an average rally of 12 to 14% or something like that over the coming year when you see that kind of a divergence. But yeah, I continue to see these inflationary things. It came out recently in Japan that they're seeing some of the fastest wage growth there in decades. I think it was, kind of in the executive suite, 6.5% year-over-year growth in salaries in Japan. So, this has been the epicenter of the deflation or disinflationary trends around the world. And so if it's happening there, it's happening everywhere. And we're definitely seeing it here in the United States too.
Mm-hmm.
No, we also wanted to touch on the downtrend with FANG. Now, one of the companies in there, Google, we recently saw they got fined $4.3 billion by the EU. And also, Google recently had a shopping fine of $2.4 billion. Do you want to discuss a bit about this and also, in general, the downtrend of FANG?
Yeah, I think there's definitely that this backlash against big tech continues to grow. There were a few things that I've noticed over the past, few weeks. One was the fine against Google, which is a pretty big deal, and I think people are like, oh gosh, well it's only $5 billion, which is not too much in terms of how much Google makes every year, but it's just the beginning, and that's only one part of the business that European regulators are looking at. There are a couple other things that I noticed. I literally got no notice 2 weeks ago, but I wish I could remember her name. But she wrote 2 years ago. I think she wrote a paper for the Yale Law Review, which basically looked at Amazon in terms of antitrust policy and how antitrust policy needs to be updated to address companies like Amazon, which clearly have very severe or serious market powers that aren't being addressed through antitrust law today. That paper went viral and became just, super popular sensation, especially, for a law review type of a paper, which, those things don't normally go viral. And 2 weeks ago, the head of the FTC, tweeted that they just hired her to work at the FTC. So, I mean, that is a huge sign to me that the FTC is taking this very seriously about rethinking antitrust policy and rethinking how they address a company like Amazon. But at the same time, too, the UK came out and said that in their Cambridge Analytica investigation, they found Facebook criminally liable for what happened with Cambridge Analytica. And to me, they imposed a very small fine, something like 500,000 euros or something tiny. But that has huge implications for the Cambridge Analytica. I mean, there were a much larger number of Americans that were affected by this, and I think it implies that Facebook clearly violated the FTC consent decree they agreed to back in 2011, which carries a fine of $40,000 per violation per user. And so you're talking over $1 trillion of potential fines the FTC is looking at enforcing on Facebook. And the UK just found that they're criminally liable for this. And obviously that fine is much smaller, but it has implications for what the FTC should eventually find in Facebook's case. So I think there's just a ton of these things that are coming to light, and investors are just far too willing to write them off right now.
Mm-hmm. Yeah, I've seen recently you've been tweeting even about Netflix a little bit, which is part of the stock dynamic. I just saw a chart another gentleman did, and I'm not going to remember his name, it's a German guy, but he tweeted a chart about the last 6 years. It shows a tight correlation between, its debt rising almost exponentially along with its share price. So they're kind of correlated. You did tweet, though, something about their CFO, aggressively insider, selling of equities with Netflix, and also a chart reflecting Netflix's revenue growth versus its equity value, basically showing that it's, earning less year over year, even while its stock price continues to rise. So, the amount of value that's there is obviously dubious, but I'm sure you have some thoughts.
Yeah, I mean, the market cap today of Netflix is essentially equivalent to that of Disney. Netflix says we're going to lose $4 billion in free cash flow this year. Disney's going to make $14 billion in free cash flow this year. Right. And so literally that, and I mean, with Disney, it's trading like 2 times sales. Netflix is trading 14 times sales, which is so astronomical and insane. I mean, after the dot-com mania, there's a great quote from Scott McNealy where he talked about, investors buying his stock, paying 10 times sales for his stock, absolutely insane to pay that high of a valuation. Sun Micro went down 95% plus after when the dot-com bubble bust. And today there's, the same number of stocks in the S&P 500 trading over 10 times sales as there were in March of 2000. Netflix is one of those stocks. And so Netflix is essentially, like Howard Marks wrote, a few months ago, if there's any stock that's priced for perfection in the market right now, it's Netflix. It's already pricing in that it will become the next Disney. So, the way I see that is if it becomes the next Disney, investors paying today's price might not even make any money. But if it doesn't become the next Disney, then investors stand to lose a ton of money. So it's reward-free risk is the way I like to think about it.
Yeah, that's a good saying. So I think next we're supposed to talk about housing. So go ahead with it, Elijah.
Yeah, essentially, I know, Jesse, you were reporting on this and how, as these baby boomers die off, there was a article online that you shared, it was talking about how baby boomers, as they die off, basically we're going to see soon, real estate crisis. If you wanted to expand on this and what kind of an impact this will have in the real estate market.
Yeah, and I think it's interesting to think about because it has implications beyond real estate. It really just comes down to the demographic challenges that we face as a country and on the planet. Really, I mean, most developed nations kind of face this same situation. But yeah, I mean, baby boomers own most of the residential real estate, and as they. And this was a report from Fannie Mae. This is not some, Wall Street research report. This is Fannie Mae saying we face a real crisis as baby boomers, essentially leave the real estate market as they, pass away. There's not the demand there to meet that potential supply. That's true not just for real estate, though, but it's true for anything the baby boomers own. I mean, I'm talking about stocks and bonds too. The San Francisco Fed put out a research report about this a few years ago too, saying that price to earnings ratios are very highly correlated. Ned Davis has also done a lot of research here. Price to earnings ratios are really correlated with demographic trends, and I think the San Francisco Fed said by like 2025 we should be looking at like an 8 to 10 PE on the S&P 500, just as a matter of baby boomers being forced to sell off their financial assets to fund their retirements. And so, that's a 25 PE today. And if, earnings growth is maybe, low single digits, that's essentially another lost decade at best for stocks. And that's a San Francisco Fed forecast. That's not, me and some, bearish, conspiracy theory or something. This is the demographic trends that we face. And I think it's also, people look at it as a potential disinflationary force. And I see it, the IMF did a study on this recently showing no, demographics are, when you have an aging population, it's squarely inflationary. Because think about, the younger generations trying to support the older generations. There's just not enough people coming in. The supply, I look at it just the supply and demand for labor, right? The demand for labor to support baby boomers and hospitals and all these kind of things and retirement homes is huge. But the supply of labor is shrinking. And so that just puts huge upward pressure on wages. And so I think we're seeing that from a cyclical standpoint right now, but there's also a secular component to that. So there's demographic trends are something that are really important to pay attention to for asset classes and the economy, for sure.
Right, and looking 2 out of 5 homes baby boomers own right now. So what is your perspective on what will happen to those homes if they are they just going to be vacant? Or are people, who's going to buy them?
I mean, that's a really good question, and it's very, very difficult to predict. But I think, if you think about, how that all fits together, I think I see an environment. These are also super long-term trends. This is not something that's going to happen tomorrow or even the next couple of years. This is, over the next 10, 15, 20 years. And so, I see an environment of rising interest rates that would just by itself probably put pressure on home prices, right? Because if mortgage rates go from 4% today to 6 to 8% again, mortgage rates were 8-9% back in the early 2000s. I don't see why they can't go back there. And if that happens, then that puts pressure on real estate. But then there's also the demographic forces also that probably put pressure on real estate prices too. That's just what kind of rising interest rates do. I mean, you look at what has pushed up equity values, it's people lowering the discount rate. Well, the discount rate, there's a very good chance discount rate's going to go up again over time, especially with the White House came out this week and said, the deficit is going to hit over $1 trillion in the next fiscal year. hit over 5% of GDP. I mean, these are all also issues that can affect the interest rates on the debt.
Mm-hmm. And one thing on that article, I think it was the Washington Post that did it. There was, they try and put a balanced perspective on it because it's obviously a bearish headline designed to get people to click. I think at the end you had someone from a National Realtors Association, obviously pro-real estate, who argued that basically, you're going to have foreign investment flow into the United States that will help prop up those prices and values. I guess that's the idea, is that we're going to have foreign currency come in this market and possibly prop up the values. So I'm not sure I necessarily buy it, but that was the positive argument for it. Go ahead. Sorry, Jesse.
Yeah, no, that's fine. I was just going to say we've seen huge foreign inflows over the last few years. I really think the risk in the short term is flows going back to Europe and Japan. That money has come here looking for positive nominal returns, and you have the ECB buying corporate bonds, and corporate bonds with zero yield is insane in Europe. Mm-hmm. And so you can understand why European investors say, I can get 5 or 6% on a U.S. junk bond. Great, I'll do that. So a ton of money has flowed into our markets from those, but it seems to me like the ECB and the Bank of Japan are going to have to follow the Fed and start to normalize policy. And if they do, that runs the risk of a lot of those inflows into U.S. assets flowing back the other direction.
Right. So, looking out in the big picture, I obviously, equities is your expertise for sure. When you're looking out as far as with your own capital, how might you be preparing in the next few years, maybe to allocate it? Are you building a list of choice equities maybe that you might buy if the inevitable, downturn comes? Or what are you thinking about in terms of your own capital? What are the types of strategies or ideas that you have?
It's interesting how, I am a diehard value investor and old school value investor. So, I wrote a piece this week, that I'm not a fan of quantitative value or trying to buy a value index. I think, indexing and passive is far too popular to lend itself to successful value investing in a passive way. So I'm old school focused, but to me, this whole discussion about the death of value really relates to that kind of a passive or quantitative version of value, because I have in the last few years found, a ton of just really, really terrific ideas. What really differentiates those ideas on the equity side, though, is these are stocks with really really low float, really high inside ownership. And so the indexes and institutions just can't own them because they don't have the liquidity. And so, you can imagine how these companies, these stocks have been essentially left for dead because the indexes can't buy them, institutions can't buy them. So there's literally no money at all going into these things. And so when I see things like, Western Refining a couple of years ago, maybe mid-2015, when the refiners got crushed, this was a company that owned the two most profitable refineries in North America, was incredibly undervalued. CEO, CFO started buying tens of millions of dollars with their own money, and nobody cared because the indexes couldn't own it. And the stock went up 100% over the next 6 months after the, So I've found a bunch of great ideas like that. It's just looking outside of the purview of the indexes. But at the same time, I don't own any of that stuff unhedged. I literally want, and I've had this position for the last, 4 or 5 years. I don't want to own anything that's not fully hedged. In terms of general market risk. So, that's kind of my philosophy. But yes, I do have a buy list of things that I would like to own. But for me, my process is much more about finding, those compelling opportunities that, I really find through insider, buying. And on the flip side, like you mentioned early on, yes, the CFO of Netflix sold essentially all of his shares over the last quarter leading into earnings. Those are other things that I pay attention to. And we're seeing that in a lot of other of those tech stocks. Mark Zuckerberg's just been unloading stock crazy. So, yeah.
Right. Yeah.
Now, you also wrote a piece recently about contrarian investing and how right now it seems like the contrarians are pretty much just following the rest of the crowd. Can you expand on that?
Yeah, I think I think value investors. There was a great article featuring Bill Miller, and Bill Miller saying, the mistake that value investors are making today is not owning stocks like Amazon and Facebook and things because they don't meet a traditional definition of value. And I think that trying to be a value investor and focusing on the things that are the subject of or kind of in the focus of passive investing. I personally believe, and I did an interview with Steve Bregman a year ago on this topic, that this market cycle is in equity market is being driven by a passive investing mania. It is like any other mania that investors are blindly buying equities. They're just rationalizing it through this passive investing kind of filter. And so anything that is the focus of passive investing, including passive value investing, is not truly contrarian. And so, to be a true contrarian, you have to look outside of that. And so I do think that's the mistake that value investors are making today, is trying to find value within these passive indexes. To think that there was another article that came out that, trying to make the case that Amazon is a value stock. And to me, that is just a wonderful contrarian indicator. There's no way in hell that the Amazon is a value stock by any way I would define it today. But the investors trying to rationalize that as a value stock is a big red flag to me.
Mm-hmm. Yeah. Well, great. Jesse, as far as the precious metals complex, obviously we've had a lot of pressure of late. Spot prices are going down. Gold typically forewarns a lot of times, especially the spot price. It definitely helps to forewarn maybe what's coming down the pike. I mean, what potentially might come out this fall? What are you expecting maybe in the next few months?
Well, I honestly think right now that the action in gold over the last couple of months is a gift. I think this is a wonderful opportunity for those investors who have been, since the late 2015, early 2016 bottom, have been kicking themselves for not owning enough gold. Now, okay, here's your chance. And it's funny because I get emails from people. I've been bullish on gold the last few years, and I can feel that there were people that feel like, oh man, I missed it. But now they're writing to me like, oh God, I can't buy it here. This is and so it's to me there's that this sell-off has created that washout in sentiment that gives you that great opportunity to buy it. And you see that in the futures positioning. The managed money position is actually back down to zero. Money managers own no gold, and that's the lowest since that 2015-16 bottom. And so I really think a lot of this is just bullishness about the dollar as it relates to the trade war, but I really don't think. And to me, that's just a short-term kind of sentiment about the dollar. The longer-term, fundamentals for the dollar are bearish, and so I think this is just kind of a relief rally in the dollar in an ongoing, bear market. Same thing, in the reverse in gold. This is a pullback, in an ongoing bull market for gold, and it just. The sentiment has gotten so bad in gold over the last, few days, especially, that I think it sets up a great opportunity.
Mm-hmm. Yeah.
And as for silver, what is your perspective on that?
I don't track silver as closely as gold, but one thing I do look at is the silver to gold ratio. And to me, that's, bumping, along the bottom of, multi-decade support level. Which suggests that if I'm right and gold's going to go higher, silver will probably outperform to the upside. But yeah, and really, I think what's going to happen here or what's going on right now is gold is ignoring these inflationary impulses. There's a chart that I look at that shows the year-over-year change in the real 30-year yield, which is just getting more negative as yields stay flat and inflation goes up. Gold usually tracks that pretty closely. They're going in opposite directions today, which means gold has some catching up to do to the upside. And I mean, I don't like to put out, forecast prices or anything, but the way I read this chart, it suggests that gold should be at least 20% higher than the current price right now. Just if it's going to start paying attention to inflation again, which is done, for decades. So the short-term divergence, I think, is an opportunity.
Great. All right. Well, Jesse, I think, is there any other topics that you wanted to bring on? Because you didn't really come with any as far as any agenda. I wondered maybe, is there anything that you want to bring up as far as topics or anything that the listeners might find interesting?
I think we pretty much covered it.
Well, great. Thanks so much for coming on. Oh, Jesse, I do have one question. That piece of art behind you, could you?
Oh, yeah.
Could you tell us about it? I mean, it's kind of interesting.
Yeah, actually, my the guy on the wall there.
Yeah.
My wife is from Flagstaff, Arizona, so and her dad was a physician there, and he grew up in Kansas, and his dad was a physician in Kansas, and so he's always collected kind of Native American artifacts, and in fact, he was in Flagstaff. He was paid in artifacts a lot of the time. So we have a bunch of different stuff, but essentially this guy, I'm standing almost right by my front door is right around the corner. This guy's basically like a good omen to, wards off evil spirits, is kind of a Native American thing. So yeah, he's just,
it's very unique. It's cool. I like it.
Yeah. Thanks.
All right. Well, Jesse Felder, thank you so much for joining us today on this week's SD Metals and Markets Wrap. Before we let you go, did you want to share with the viewers, if they're interested in learning more, where they can find you?
Sure, yeah. I spend, as we mentioned, a lot of time on Twitter. I tweet a lot of the stuff that I read every morning. It's just at Jesse Felder. And then I blog pretty regularly at thefelderreport.com.
All right. Sounds good. Well, this has been James Anderson, Elijah Johnson, with our guest, Jesse Felder, for this week's SD Metals and Markets Wrap. Thank you so much for listening.